If you're looking to get pre-approved to purchase a home, there's basically four things that the mortgage underwriter is going to look at to determine your ability to get approved. I'm going to break that down into four parts so that you can really take your time and be able to break down piece by piece what you're going to need to do to be able to get a successful loan application submitted and give you a high opportunity to be able to get yourself approved. Number one, income. We need to see that there is consistent income that's coming in. At the end of the day, what the bank needs to know is the money that we let you borrow, that you are going to be able to pay that back. The reason and the way that we're going to be able to determine how you're going to pay that money back is looking at your income history. We want to see stability, we want to see stability in that income that you have coming in each month. Now, a couple different things. If you're an hourly employee and you get work, you're set to work 40 hours a week, we need to see on those pay stubs that you're going to work 40 hours each week. If we have one pay stub where it's 32, another one where it's 38, another one is 39, then there's a couple of this 40, then it goes back to 32. You get my point? When you have that, we can't give you credit for 40 hours each week if your pay stubs don't show that it's 40 hours each week, right? Now, if you're on salary, we want to be able to see that the salary is consistent, right? If you make $60,000 a year, we want to make sure that when we're calculating your year-to-date income, it's trending that you're going to make that 60,000. Sometimes you may be taking a little bit of time off of work where you don't get paid, or if you exceeded the PTO that's been allotted to you. So just because your contract says 60, but if we look at your pay stubs year to date and it's not tracking for you to make 60, we can't always give you credit. So when we're looking at your income, we're really scrutinizing it to make sure that although this is what you say you're making, we have to be able to look at your income through your pay stubs and your bank statements and your W-2 forms, etc., to make sure that those things are lining up. We're looking at, is that income consistent? Now, there's also variable things that are out there, like overtime and bonus and commissions and shift differentials. Those are all different things that we'll gladly give you credit for. However, there's two things that you must establish. Number one, you must establish a history of it. We must see that, hey, you've been earning this type of income on a consistent basis. Most of the time, we want to see that you've been earning it for at least 2 years, but depending on the loan program you qualify for, we may be able to give you credit for it after it's been at least 1 year. Now, typically, if it's been less than a year, it's highly unlikely that we're going to be able to use that income. Because again, we're looking at two things. History, have you been receiving it before? And likelihood to continuance. Are you going to get it in the future? Now, we're not looking for a guarantee that you're going to get the income in the future. We're looking at the history to determine, is it likely to continue? Okay. Now, there's a couple of nuances, things come out, like, and I'll give an example. You were, working and you were working at one job and you left that job and went to another job. Now the new job pays you commission income. So again, if we cannot determine the history of that said commission, it's likely that we're not going to give you credit for that commission until you've been on that new job for at least a year. Again, preferably 2 years, but when you get to at least 1 year, you have a chance. So those things also apply to as well to fixed income. If you're on Social Security, or you get, some type of disability, or if you get, alimony or child support or whatever the case may be, we're looking again at two things: history of receiving it, likelihood that it's going to continue. So being on fixed income isn't a problem. It's no problem at all. Again, with the examples I use, pension or retirement or disability or alimony or child support, it's fine. But we have to establish history and likelihood that it's going to continue. Now, the other thing that comes up quite a bit is self-employment income. Being self-employed is not a problem. However, we still have to establish that basis of income. When we go in and we're looking at either your Schedule C or your K-1s or your corporate returns or whatever the case may be, is one thing for your top line, whatever your gross receipts or your gross revenue is. But we're going to do everything based off of your net revenue, what your bottom line is. So be very careful when you're talking to your accountant or whoever prepares your taxes. You're letting them know that you're going in to prepare to get a mortgage. We are not going by your top line or your gross receipts or revenue. We're going by that net income as far as what you're reporting to the IRS. Very critical. Same thing. If you're self-employed, we're going to want to see 2 years, right? We're going to look at the last 2 years of that net income, and typically we're going to average it out. So understand, self-employment is not a problem, but we still have to show the consistency in that income. So if you're getting on track and getting yourself in preparation to be able to qualify for a mortgage, understand the income piece of your loan application is something that we're going to dive into and we're going to scrutinize. 2 things: likelihood of continuance and history of earning that income. If you're able to nail those 2 things, you have a very good opportunity to be able to use that said income that you're trying to qualify with to be able to get you on track to be able to purchase that home.